All right, good morning, everyone. Thank you for joining this morning's New South Wales Dairy Breakfast. It's hard to believe it's the last one of the year, but we'd like to welcome Sheena Carter and Fiona Smith for joining us today. Sheena's a development officer with DPI, focusing in farm business management. We've got Fiona Smith, a farm business consultant with Dairy Australia, and they're both heavily involved in the Dairy Farm Monitor project. Sheena more linked with New South Wales and the data collection, validation and producing the report, and Fiona more from a national context. But before we start today, I'd just like to acknowledge the traditional owners of the land on which we're meeting today, for elders past, present and emerging. So look, Sheena, I think, so just to let you all know, we're recording today's meeting. And we'll have questions after each presentation. So when Sheena finishes, we'll have about 10 minutes for questions, but feel free to write the questions in the text as we go in the chat box as you like, or maybe at the end, if you raise your hand, or just take yourself off mute and we'll go from there. If there are any questions that we can't get to, if we run out of time, we'll endeavour to catch up or email that back after the meeting. But thanks everyone. Sheena, I'll hand it over to you.
Thank you, Zita. Look, it gives me great pleasure to be able to share the really positive results for New South Wales that we've seen with Farm Monitor this year. It's a milestone. It's our 10th year in New South Wales of Dairy Farm Monitor, and we've also had the most number of farms participate. So a huge thanks to all of the 41 farms this year. It's grown in that 10 years from 28 to 41. So really do appreciate it. Without them, we couldn't do this. They're very generous in sharing their information and time in pulling the reports together. They are anonymous, but they do contribute greatly to this project. And a big thank you also to our data collectors across the state. I see we've got a few of them on this morning's session, which is great to see. It's a massive job. There's lots of toing and froing in order to get the files right and as accurate as we can. So thank you to them, and also to Fiona and Kerry Kempton, who also do a lot of the data checking and validation as well. And a big thank you to Dairy Australia for partnering with us for the last 10 years of the project. It's been a strong and productive relationship, so thank you very much to them. Just a quick bit of background around Dairy Farm Monitor in case people aren't familiar with it. It's a project that provides comprehensive physical and financial analysis of dairy businesses across the state. And this is used by industry and government as its objective and farm level information that can be used for strategy and prioritisation and decision making across the industry. As mentioned, it's delivered by us, by New South Wales DPI, in a funding partnership with Dairy Australia, and we're strongly supported by the regional development programs, Dairy New South Wales, Subtropical and Murray Dairy, where they slot into the New South Wales state. So thank you to them. It's part of a broader national project which is run in all the dairying regions. There's over 250 farms across Australia that participate in this project. And the data also sits behind Dairybase, which many of you will know it's a free online tool that farmers and service providers can use to measure and compare their performance over time. The information is also used as background information in reports such as Dairy Australia's situation and Outlook reports and various others that pick it up. So it's really information that gives us an accurate and an impartial picture of how the farmers are responding to the external forces that present to them each year. It shows us trends in the industry over time. And within New South Wales, it allows us to pick up on some of the regional variation that we get across our large state with many dairying systems and climatic zones in it. So I also want to just, a few caveats on what we're going to look at today, which I'm going to talk about average data for the project. So the results are a summary of the participating farms only, so the 41 farms in New South Wales. It's not the whole of the New South Wales industry, but we do try to get a good representation of the industry across the state. We do have movement of farms in and out of the project each year, so we need to be careful when we're comparing between years. It's not a longitudinal study of the same farms over a period of time. I think from the original cohort 10 years ago, there's 8 farms that are still have participated in every single year. So it's not a longitudinal study. There is movement in and out. And we've always got to context the numbers. Again, I'm talking averages, but when we look at the individual farm performance results, they're a factor of many things. But I guess the main factor is the people behind the business. So every business has, people that have different goals, different aspirations for the business, and they're all presented with different resources that they've got to manage with the skills that they bring to their business. So, and they use those skills and resources and manage them according to the different conditions that are thrown their way in any given year. And we know we've certainly had a few challenging ones over the last 3. So yes, I will be talking average numbers, but it's all driven by these individual businesses. This is a map that just shows us the rough distribution of the farms throughout New South Wales for the 2021 year. You'll see, we've got a strong concentration down the coast, which is where the majority of our New South Wales farms are. And then we've got a representation of inland farms as well. We do split the data into north and south, which is it's a challenge, but it's to reflect that climatic variation, a difference in systems as well. So you'll see some of these inland northern farms we tend to put in the southern group more because of their type of farming system compared to the northern farms. So yep, 22 in the north and 19 in the south this year. Just some more around the context. Obviously, it was a very wet year, above average rainfall across the state, and 1 in 100-year flooding in many parts of the seaboard, eastern seaboard, which was very damaging, particularly in the north, where we saw significant effects on quite a few farms. So the green line here is the average rainfall for our 22 farms. And we can see in that December summer period, there was a lot of rain, which sort of tapered away. But then come autumn, there were phenomenal amounts of rain. We already had fairly full soil moisture profiles. So that obviously meant that there was just far too much runoff. And this obviously impacted a lot of businesses, not only in terms of, loss of fodder, in some cases loss of livestock, but there was also infrastructure damage on farms, and of course the subsequent animal health challenges, mastitis, lameness, etc., which obviously had short-term impacts on these businesses, but it also has, as we know, sort of medium to longer term effects as well as they try to recover. In the south, which is the blue line, again, on average, they had above average rainfall. So, and, significant flooding or even repeated flooding on parts of the south coast. I was talking to one farmer who had to resow his autumn pastures 3 times. So it did present challenges across a lot of our dairying region. This is our 12-month rainfall deciles, which just, tells the story again. In pretty much all of our dairying regions, it was above average to very much above average rainfall across the state. And I guess another impact was the delay to sowing that many farmers had with their autumn pastures. They weren't able to get back on until June in many instances. So, that's obviously going to have impacts on the amount of homegrown feed that they could grow in that financial year. This next slide is it's the profit map, and I'm just going to step through it so we're all on the same page when we're talking about the numbers and profit. It's the profit methodology used in Dairy Farm Monitor and also Dairy Base. It was adapted from the Farming Game by Bill Malcolm and others. And if we sort of start at the top, well, I guess the main point is that it allows a consistent approach nationally in Australia on how we're talking about farm businesses, and also within the Dairy Farm Monitor project and Dairy Base. So if we've got a true profit analysis, we're looking at cash and non-cash items in the business. So it gives us a full description of how the assets and resources are used in the business to generate an income. So a business will start at the year with a certain equity and debt position, and we look at the gross farm income in the business. So that is obviously milk income, predominantly milk income, but it's also comprised of things like livestock trading profit and other farm income, whether that's, you know, fodder sales or it's other farm related income. So I'm just going to step through this map to explain how we derive these terms. We've got, from our gross farm income, we take away our variable costs. So our variable costs are our herd, shed and feed costs, and it also includes an adjustment for feed and water inventory changes. So of note was in the south, we saw many farms increase their fodder inventory as a result of improved conditions, which we didn't see so much in the north. And some of this was impacted by the floods. Those farms, you know, they were having a fantastic season and had put away a lot of fodder, but they had to draw down on that as a result of the floods. I mean, some farms were completely covered in water. So unfortunately, that meant they drew down much earlier on their fodder reserves. So yes, gross farm income, take away our variable costs. That then gives us our gross margin. And from our gross margin, we take away our overhead costs. So again, we've got cash and non-cash overheads. Our cash overheads are things like paid labour, that tends to be the largest one, repairs and maintenance, insurance, rates, etc. Then our non-cash costs are things, well, it's depreciation and imputed labour. So generally that family labour, which we value in Dairy Farm Monitor at, it's $76,800 across a year for one full-time equivalent. So a full-time equivalent is someone working for, one full-time equivalent is 2,400 hours worked in a year. So gross margin, take away our overhead costs, gives us our EBIT, or earnings before interest and tax, commonly referred to as operating profit. From our operating profit, we take away our interest and lease costs, which we call finance costs, and that generates our net farm income. So from our net farm income, once we take away tax, this leaves us with whatever's left over in the business, which can be used to either, you know, pay down debt, reinvest in the business or outside of the business, and hopefully contribute to a growth in net worth at the end of the year. So we also talk about return on total assets. So it's return on total assets managed, all assets managed, owned and leased. And our return on total assets is EBIT, our operating profit, divided by the value of all the assets managed. And our return on equity is that net farm income. So EBIT minus interest and lease costs, net farm income divided by the equity in the business. Now, when we're analysing dairy businesses, we look at it through a number of different lenses. We don't report on all these in our annual report, but obviously there's the cash position, the profit position, and the wealth position. So in general, it was a very good year in terms of business performance, which is particularly pleasing given the very difficult period we've been through in New South Wales over the last few years with extreme drought, but also fires and floods, and you know, all in a very short time period. So there have been lots of challenges, but and on average, I certainly acknowledge that some farms have been impacted more than others, but on average, our cash flow increased, our net cash flow. 1920, it was around $11,800 at the end of the year. At the end of the 2021 year, there was $110,000 in net cash flow. So what this meant was we've seen through the data more money available to spend on repairs and maintenance, a paying down of debt on many farms, which also has the flow-on impact of reducing interest payments on average in our data set. If we look at the profit position, very pleasingly, it was the highest average operating profit in 10 years of Dairy Farm Monitor in New South Wales. So our EBIT, our operating profit, was $2.07 on average across the 41 farms. So as a comparison, in the 1920 year, it was $1.05 per kilo milk solids. And we had 37 farms out of the 41 had a positive EBIT. So we still had a range in profitability across the data set. Then we go to wealth. Now, with the wealth position, we see a slight decrease from 73 to 70% equity this year. And this is where we need to be mindful of the movement of farms in and out of the data set. I've looked at the wealth position with only the farms that were in the 1920 year and in the 2021 year, so the same farms across the 2 years. And in that instance, we do see a slight increase in equity of those farms. So there's a slight increase from 72% equity to 73% equity if we're just looking at the same farms across the 2 years. So these farms, they had a slight increase in liabilities by about $168,000, but the value of their assets increased by around $671,000, which was due to a number of factors. There was, we adjusted land values this year in the data set. Obviously, we're well aware that land prices have been going up recently. Some farms had an increase in livestock inventory growth, particularly in the north, and also plant and equipment, additional plant and equipment, and we did see a number of farms acquire new land as well. So that's a very positive sign coming from the industry. So our $2.07 operating profit, that translates to an average of $471,437 per farm. In operating profit, once we took out our interest and lease costs, our average net farm income came to $370,619, which we can see is a fantastic increase on the year before. This then translates, our $2.07 EBIT translates to a 4.9% return on total assets. Now, we might expect an EBIT of that figure to translate into a higher return on total assets managed, but that value, I guess, has been somewhat constrained by asset value, particularly of land, and particularly in our coastal regions where we see high land values. It's agricultural land, but it's impacted the value of that land by non-agricultural industries as well. If we now take a look at the physical characteristics of the 41 farms, so I've just pulled out a few key things here. If we look at the production, milk solids averaged 522 kilos of milk solids per cow. The figure in brackets underneath is the 1920 financial year. So we can see that there was a larger proportion of homegrown feed in the diet with improved conditions, better pasture growing conditions, and also cooler temperatures across our summer period. Our labour efficiency was on a per kilo milk solids basis was pretty similar to the previous year. Likewise, on a cows per FTE basis, it was pretty similar. It's important to note, though, that we do see big differences between the farms in the north and south data set. So if we look at the north in comparison to the south, we can see that in the south, they tend to have higher production per cow than in the north, and also better labour efficiency. We did see more homegrown feed consumed in the north farms than in the south also. Some of the main, really the main influences that we saw on profit, if you want more detail, this is all available in the annual report and on an online tool that we've developed this year. But at a high level, the profit position was really influenced by a couple of key things. So we've still got strong milk prices in New South Wales. There wasn't a great deal of change on prices from the previous financial year. And I guess these are at this level due to ongoing competition for milk as we continue that sort of recovery from our drought years. We did see an increase in livestock trading profit on the back of, I guess, a couple of things. Obviously livestock prices are phenomenal at the moment, and we also have a number of farms selling heifers into the export market. But if we look at our purchased feed and agistment costs, they were down 30% on average across the data set. And this is one of the main drivers of the improved profit position. So we can see behind that are a couple of things. Concentrate prices and hay prices have come down, but as per the previous slide, we've also got an increased amount of homegrown feed in the diet, which is generally cheaper than that purchased feed source. Again, we see the differences between the north and south. There's always a difference in New South Wales in our milk price between north and south. The southern farms tend to be more influenced by that Victorian milk pricing system coming over the border. And in the north, we see a couple of things. I mean, we are in a liquid milk market, which influences our milk price, but we also see the influence of some of the Queensland milk pricing filtering down into northern farms in New South Wales. Livestock trading profit made up a larger portion of gross farm income than in the south, in the north and in the south. And there is some sort of regional difference in purchase feed prices that we see in the north and south. Predominantly, this is often due to, getting that feed source from where it's grown to those dairying regions in the north. So it's sort of a freight component. And then consequently a slight difference in purchase feed and agistment costs across the data set. Next, if we look at the regional performance, and again, there's more detail in the annual report, but I've just separated out here the north farms and the south farms. So this graph, we've got our profit, our operating profit per kilo milk solids down the left-hand side, and each of these data points is one of the 22 farms in the north. So the north had an average EBIT of $1.59, and we can see there is a range in performance across that data set. But that $1.59 is stronger than it was the previous year, and as a result of a decrease in purchase feed costs, increase in livestock trading profit, contributing to our gross farm income. And there was the impact of drawing down on fodder reserves as well, predominantly due to the flood. Still our highest return in 10 years for the north cohort. If we look at the south, we had an average EBIT of $2.62, which is fantastic. Again, we still have a range in performance across the data set, but we can see there's a lot of the farms sitting between that $2 and $3.80 per kilo milk solids in the south. So again, a reduction in purchase feed costs per kilo milk solids and an increase in fodder inventory contributed to that, and obviously the highest return for the south in the 10 years of the project. So really pleasing results across the board there. For the south, that translates to a 6.7% return on total assets, and for the north, it's a 3.3% return on total assets. We also do a survey of all the farmers in the project. So it's a survey, it's specific targeted questions. We ask them about their sentiment on the year ahead. So the data is collected sort of late July into August, and that's when, that's the frame of mind they're in, whatever's happening at that time of year. That's when they're surveyed. So a short term, the year ahead, what does that look? And also a longer term, looking 5 years out, what are some of the key priorities for your businesses? But if we look at the short term stuff, which is for the current year financial year that we're in terms of business profits, all farmers expected profit to either improve or remain stable. In terms of milk prices and production, all of them except one expected milk prices to either increase or remain stable, and likewise for their milk production. Input prices, we asked them about. Most farmers expected their input prices to remain stable, with the one exception being fertiliser, which is obviously no surprise, and we're well and truly living that at the moment. Fertiliser and chemical prices increasing dramatically due to all sorts of world issues. So I just thought I would, it's not completely a conclusion, but just some opportunities and challenges given on the back of the result that we've seen for the 2021 financial year. Obviously, there's more cash in the business in general at the moment, and this is certainly an opportunity to pay down debt. Now, whether that's long-term debt or short-term debt that might have been accrued as the result of drought, whatever it is, it's certainly an opportunity now to start paying down that debt, or reinvesting back on the farm, perhaps capital expenditure investment or upgrades to the farm that'll improve your operational efficiency in the business, or you could invest that off farm. So there's a chance to build wealth within the industry, and we're certainly seeing that happen, both within the farm monitor farms, but also other farms that I talk to, which is, I think it's exciting times for the industry. Also, an opportunity certainly to build fodder inventory with the favourable seasonal conditions, depending on where you are at the moment and if you can actually get on your paddocks. But it's certainly, with these milder conditions, excellent grass growing weather, and an opportunity to build that fodder inventory for the tougher times ahead, which we know are inevitable. The challenges, I think the strong milk and livestock prices are, while they're certainly an opportunity and a benefit, they're also a challenge. We know these aren't going to hang around forever. I think Rabobank put out a report recently saying that, with the tightened world supply of milk, we might perhaps see these milk prices hang around for a while longer. But they are really driven by supply and demand. So as a farm owner, they're predominantly out of your control. So we need to manage our costs really within our business and try and set our businesses up to be able to weather those tough times, but also take the opportunities with the good times, as we're seeing now. The input prices obviously are going to perhaps reduce the margins somewhat in this 21-22 financial year, I think. But I think it's really a time to do some of that marginal decision making and an analysis in your business. So, we've got high fertiliser prices, but depending on your response rate to nitrogen at the moment, it is certainly economical to still apply nitrogen despite the high prices, and generate that surplus feed if you need it, or to put away as inventory. It's economical in terms of comparing that to buying in an alternative feed source. So I'd certainly be crunching the numbers on that and making the most of those opportunities. Another challenge is, we've got strong milk price to grain price ratios. So often we see farmers in this situation increase the amount of concentrates they're feeding in their diet. It's a quick response to generate more milk by feeding more concentrate, but we need to be careful. It can be very hard to pull back out of that system once you've gone down that route. So it's be mindful. Don't lose the focus on grazing and utilising high quality homegrown feed. And that doesn't matter whether you're a pasture-based system or a TMR system. The same principle applies. The more homegrown feed that you are growing and utilising, and of quality, that certainly sets you up to make the most of these conditions. So if we look at cost of production just quickly, we can see that we've certainly come back a long way from where we were, following the impact of drought, very low homegrown feed quantities in the diet generally, and exceptionally high purchased feed prices. So we're back down to $7.94 on average for the state, but we're still, you know, not as low as we were in 17, 18. And I know, you know, the lowest cost of production doesn't necessarily create the greatest profit because of all the factors and variables that impact production. But if we looked at that $7.71, that was in a year where we had an operating profit of only 34 cents per kilo milk solids. We had much lower milk price and, you know, overall gross farm income. We didn't have those high livestock values. So I guess my message is don't get complacent just because we've got strong milk and livestock prices at the moment. So if you'd like further information and detail, we've certainly got the annual report, which sits on our DPI Dairy website and also the Dairy Australia website. And Zita and I have done a podcast recording for our monthly The Business of Dairy podcast, which will be released on the 1st of January. And I'm sure everyone will have nothing better to do on the 1st of January than listen to our podcast. So, you know, depending on how you're feeling, tune in. We've also generated an interactive report for Dairy Farm Monitor for New South Wales this year. And I must admit, this was an idea that was pinched. I've pinched it from Sam Henty, who has done an interactive report for Agriculture Victoria with their livestock farm monitor. So thanks to Sam for his idea, and it's been pulled together by Juan Garjulio, who I think might not be on our call today. But I'm just going to try and give you a quick glimpse of what it looks like if my internet will play ball. So this is available on our website, DPI Dairy website, and it's just a high level look at the results in the financial year. So we've got up here a general tab, which gives you this page. So it's just some key metrics. This shows the farms in the data set and color coded for North and South, and then some high level financial parameters and physical parameters. You can filter that by North, South, or look at an individual farm. We've also got a few years of financial, a few financial years in there at this point, not all the 10 years at the moment. If you click on the historical tab, then we start to look at our trends over the 10-year period. So feel free to have a look at that, and if you've got any feedback on that, I'd be more than happy to hear it. And if it's of any value, it's just sort of a way to make it a bit easier to look at the data. So finally, if you're not part of Farm Monitor and you're a dairy farmer, there are multiple ways for you to get your business analysed and understand how you're performing at the moment. We've got through the Business Support Services project, which is being administered by Dairy New South Wales, but it's available to all farmers in New South Wales. You can have a consultant come and sit with you and help get your information into Dairybase or the Farm Business Snapshot tool. And the Snapshot tool is a simplified version of Dairybase. It's less onerous in the amount of physical data that has to be put in predominantly, but it is an excellent tool that's also available online. Or if you'd like to get involved with Dairy Farm Monitor, we're always keen to grow the numbers in the data set. So reach out if you'd like to be involved for the 2022 financial year. It's not guaranteed that you can be part of the project. I do need to get an even sort of distribution of farms across our dairying region so that we don't skew the data in one particular region with heavier weighting. But I think I'll wrap it up there, Zita. So thank you.
Great. Thank you very much, Sheena. That was a fantastic overview, especially for the 10th year of the project. It's great to see those results. Look, we've got a couple of questions. I might just kick off with one that Paul sent through. It's related to the labour use efficiency between the North and the South, and also maybe how it compares to other regions. He was just keen to hear your views on the differences there.
Sure. Look, we always see a difference between our North and South data set in terms of labour efficiency, and it's a multifactorial thing, and we could probably talk about it for hours and still not get to the bottom of it, Paul. But look, you know, part of it is system. We've got generally, we've got sort of larger farms in the south than in the north. And we tend, if we look at our imputed labour, it tends to be higher in the north than in the south as well. So more sort of, I guess, and I'm generalising here, but smaller family-sized farms. Some of it is, perhaps farm layout and efficiencies within the farm in managing the herd and, operations within the farm. That can present challenges as well. And it's also a factor of, in terms of cost per labour unit or per kilo milk solids, obviously an impact of scale as well. But in terms of dollars per kilo milk, in terms of kilos of milk solids per FTE, it is often a bit of that size impact and system that we're looking at that's influencing that. But there's a lot of things that come into play.
Yeah,
we're looking at.
Thanks, Sheena. Now I've got one from, I think, Nico, you said that Fiona had one before. Is that right? Nico, have you got them there?
No, yeah, but it's not from Fiona.
Oh, sorry.
There's another question that came through. So there's two questions that came through. One is, are you expecting homegrown feed to drop on the back of people using less fertilizer, or will they still kind of be betting on that one as the cheapest feed source?
I hope it doesn't drop, because we've done a podcast which talks about nitrogen use. That was our latest podcast. It is still economical to to apply nitrogen to pastures and generate, depending on your response rates, generate homegrown feed, which is still going to be cheaper than buying in an equivalent feed source to generate production. And I think there's a lot of people in industry that are trying to get that message out. Yes, nitrogen prices have gone through the roof, but it is still economical depending on what you're applying it to, and all the agronomic things that you need to be mindful of. Moisture, which doesn't seem to be in short supply at the moment, depending on where you are, the type of pasture you're applying it to, and the response rates. It's still economical to grow that homegrown feed rather than putting yourself in a corner because you haven't, and then having to rely on purchasing in relatively more expensive feed.
Perfect. And there's another one, Sheena, that came through is, do you expect, if interest rates go up, to have any impact on in the way people are running their business?
Look, if interest rates go up, it'll certainly have it depends how much they go up by, doesn't it? But it will have an impact, certainly, on interest payments on average across farms, definitely, as it will in any industry, regardless of whether it's farming or, you or I buying a house in any location in Australia, that debt servicing position will be impacted. But yeah, again, I guess that's all part of your approach and risk appetite and how your business is set up, and how you plan to manage that. And I would be, if you think interest rates are going to go up, I would certainly be looking at your own figures and working out the serviceability of that.
Thanks, Sheena. There's just a comment here from Rob Cooper saying it's great information, and what are we doing to use this information and other ways to help those farmers not getting, the $3 plus kilograms, like $3 per kilograms of milk solids EBIT, and how to better achieve those results, because he's saying there's a lot happening, but we need to do more to help farmers kind of achieve that performance. I don't know if you've got any comments there, Sheena.
Well, I think the first step is for farmers to actually understand their position, where they're at. There's no point, if you don't know your own position, looking at other positions and saying, how are they doing a $3 EBIT? First of all, understand your own position. And from that, and the business support services project, or just, getting in touch with someone who can help you generate those reports is the starting point. You need to know your own figures, and then you can start to look into your own results. If you want, you can compare against industry standards, but I think it's really comparing against yourself and looking at opportunities within your own business to do that. And there's initiatives out there to help people do that. And look, I'm certainly hoping to get some time next year to look at the 10 years of results in New South Wales and pull out some more insights into our performance in the industry over that 10-year period. And hopefully I'll have some resources that come with that, or case studies, whatever it might be, to help people understand. But I think the challenge is that, as I said earlier, every farm is unique in its resources, its people management, etc. So that needs to be factored in as well. What can you generate with what you've got and your own skills?
Yeah, absolutely. Now, are there any more questions that people want to write in the chat, or you can take yourself off mute briefly before we move on to Fiona? Happy to take one more. No, looking okay for now. Okay, thanks very much, Sheena.
Sita, I've
yep.
put in the chat all the links if people want more information. So the Dairy Farm Monitor, the interactive tool, and the podcast.
Great. So if people want to follow that up after today's session, jump to those links. Okay, thanks for that. Thanks, Nico. So now I'll hand it over to Fiona. So Fiona, is your audio working there?
I hope so.
Yep.
Let me know if it's not better.
No, that's good.
If I turn into a robot.
No, that's great. All right. Thanks, Fiona. So Fiona's give us a national overview of the results. So over to you. Thank you.
Thanks, Zita. I'm just going to quickly come back to Rob Cooper's question as well around the EBIT position. Whilst it would be fantastic to get all farms up to $3 per kilo milk solids on EBIT, probably just worth keeping in mind that the national target that's been set is around getting $1.50 per kilo milk solids for 3 out of 5 years, which should typically give a return on total assets of 5% across what we call a standard kind of farm within the industry. So $3 would be fantastic, and I suspect growth in the industry would be quite different at $3 if we could get all farms there. But just keep in mind that $1.50 is sort of the target for 3 out of 5 years as part of the National Dairy Plan's targets that were set. So just wanted to add that to what Sheena had already said. Now, as Zita said, I'm going to take you through some national results for the 2021 year. Please keep in mind that these don't currently include Tasmania. Their results come in a little bit later, and the indicative ones we've got so far I don't think will represent what the end position is for 2021. Biggest thing to note is really solid performance across the Australian industry this year. So I think for all bar a couple of the Victorian regions, it was their best result in terms of EBIT and return on total assets over the history of the Dairy Farm Monitor project, which I think is a fantastic thing. Probably just reiterates Sheena's sentiments that whilst it's been good, it's also a really good time to spend that money wisely and prepare for what might change in the future as well. So I've got each of the states summarised that you can have a look at. I won't talk through all the numbers, just in interest of time and making sure you can all get away at 9:30. But I'll go through a couple of the figures. So return on total assets, which is the general measure that we use when we're comparing farms across different regions, because it takes into consideration the quality of resources that everyone's got available to them. Obviously, the higher your asset value, the higher the EBIT that you need to get a comparative return on total assets. So just keep that in mind. A lot of these regions have had, I suppose, a revaluation up on land values probably over the last 2 years, a bit like Sheena said for New South Wales. Most other regions are increasing in land value partly from demand from other agricultural commodities, but we're also seeing increasingly, I know for New South Wales, there was a lot of assessment this year where partly urban sprawl, partly everyone deciding they don't want to live in cities anymore because of COVID, and lots of people moving out to regional areas, which has also driven land prices. So we have seen probably a disproportionate increase in EBIT that hasn't been reflected fully in the increase in return on total assets across regions because of that increase in land price. So just keep that in mind, that when you're comparing to the last few years, the EBIT response probably looks better than the return on total assets, just because of what's happened with the revaluation of assets across that time. So overall, most of those regions had their best result ever, with some really good return on total assets, and return on equity being higher in all of those regions than return on total assets, meaning they're getting a better return from the money that they've got with financiers, which is a good thing. EBIT per kilo milk solids, as I said, the $1.50 target that we have across industry, with the exception of Queensland for this year, all the other states and regions achieved that, which is a great thing. Off relatively stable milk prices compared to last year. If we go Australia-wide, there were some increases in some regions and reductions in some. Livestock trading's probably been, I suppose, the standout contributor to increasing overall income across farms. Improved trade on export heifers, and overall improvement in the cull prices that farms were getting. Plus, we are now seeing consistently what we would classify as integrated beef or trading operations sitting within dairy entities. So most regions are now, we have the livestock classes in Dairy Farm Monitor are cows, rising twos, rising ones, bulls, and other livestock. And we've probably found, I think Sheena would agree, that over the last 10 years, that other livestock proportion has just increased every year. So more farms retaining younger stock for longer, and more farms electing to have an integrated beef operation or rearing young stock for longer to contribute to livestock trading profit. I will come back in a little bit to talk about that impact that it's had on labour efficiency. So coming back a little bit to what Paul's question was earlier about some of the impact that that's having on labour efficiency. So cost of production overall, as Sheena said, it's been a positive trend for New South Wales, positive trend across the board, to be honest. So feed costs dropped quite substantially across most regions this year. Purchase feed costs were lower because overall for Australia there was more rainfall and more ability to grow feed. And so there was a combination. More people had a greater proportion of homegrown feed in the diet or grazed feed, and feed costs were lower. So when you combine that together, overall the feed costs in each of the regions did drop compared to last year, and compared to historical figures, feed costs were relatively low across the board. Equity is interestingly relatively similar across most of the farms. Western Australia probably, as you can see, comes in with the lowest equity, and actually Queensland coming in at the highest equity in terms of actual percentage across the board. So they're the main, I suppose, what we call financial key performance indicators. So some of the key ones that we look at when we're doing a farm business analysis. And I'll just move on. So these are the key physical characteristics. I'll work through some of these, but not all of these. Usable area, Western Australia and South Australia do consistently have that bigger area, partly the rainfall that they've got, partly just the systems that they're running. So a lot of those farms have actually got quite large usable areas where they're producing a lot of homegrown feed to bring back into the dairy operation and to run all those extra other livestock. So Western Australia, for example, has the biggest proportion of additional livestock in their system on top of the milking animals, with some of those farms actually having other livestock numbers that actually are very similar to their overall dairy proportion of the herd. So in terms of the labour efficiency question we had earlier, I think industry-wide there's probably been some concern around labour efficiency. There's also considerable concern around labour in general because it's really hard to get as a result of COVID and other industry impacts. It is getting more expensive to get labour. We've seen certainly in South Australia this year a big shift to overall labour costs actually dropped on a per kilo milk solids basis, but the imputed labour portion increased quite significantly compared to the paid labour just because they couldn't get staff. So it actually just meant that the imputed labour actually just had to work much harder, much longer hours and not have holidays. Labour efficiency, I've got it there in a cows per FTE and milk solids per FTE, which is the one that Sheena referenced during her presentation. We just need to keep in mind that labour efficiency is getting slightly harder to measure just against the milking cows and the milk solids per FTE, because lots of farms are now doing this integrated other livestock, and there are lots of farms that are now moving to having larger usable areas to grow more of their own homegrown feed because they can do it cheaper than purchasing it, but it means that they've got to have extra labour on the farm to actually do that. So just be mindful that when we're talking about labour efficiency, those things have to be taken into consideration. And coming back to Sheena's comments, there is also an element of system-based difference in labour efficiency. So I don't have the Tassie results there. Tassie has the highest labour efficiency, keeping in mind that Tassie gets rainfall pretty much all year round. So if you want to talk about reliable rainfall, Tassie is a good place to go, with the exception of areas of New South Wales this year that have had reliable, very frequent rainfall, but possibly just a bit too much. So Tassie does have that element of largely a pasture-based system, and they only calve once a year. So there's always going to be differences in labour efficiency just based on the systems that people run, and also around the ability to have a long growing season with pasture. So there's lots of those things that come into play as well. I've included some extra things there in terms of percentage of homegrown feed in the diet across all of those. Keep in mind, WA sometimes surprises people because they don't necessarily think of WA as being high rainfall, really consistent pasture growth. Because they have such a large usable area, they're making a huge amount of crops and fodder on that usable area to support the milking platform. So that means that they've got a greater proportion that's coming from homegrown feed on usable area. The next one's the tonne dry matter, so the actual total homegrown feed on milking area, which is comprised of the grazed feed and the conserved feed. And consistently across the board for the 2021 year, that had a relatively, I suppose, positive relationship in that most areas actually had an increase in homegrown feed. Probably the fact that a lot of Australia actually came out of drought and managed to get rainfall has a pretty big impact on that, like Sheena had said, with the exception of those farms that were impacted obviously by flood and fires that came into some of that time as well. And the last one I've done is the grazed feed fed tonne dry matter per cow. Just an interesting one to look at in terms of the systems that we look at. Often what we're seeing now, and keeping in mind the milk solids as a percentage of live weight, so looking at trying to achieve, if we're talking about productivity and profitability, so it's essentially about trying to make sure you've got efficient cows, so efficient cows that are producing the right, I say that very carefully, the right amount of milk solids as a percentage of live weight of cost-effective feeding. And keep in mind that milk solids as a percentage of live weight is another one of these ones that is problematic to compare between farms and is problematic to compare across regions, just because it does depend on the system. Pasture-based systems do find it a little bit harder to get that milk solids as a percentage of live weight higher, just based on the proportion of diet that they've got. And it is all about, if anyone's heard of John Mulvaney's Tower of Resilience, it's all about balancing all these different elements. So when it comes to these physical and financial characteristics, you'll notice with each of the regions that they're different across lots of different measures, but it's balanced by something else. So Western Australia has some issues around obviously the consistency of rainfall and their ability to get rainfall. So their choice there is to have a bigger usable area, rely more on livestock trading to prop up their income, and therefore it has a flow-on effect to other things that they're doing in the system. So it's all about balancing all these different elements to try and improve profitability and overall productivity across those farms. So Zeta, I did have some graphs just in terms of the historical returns across each of the regions, but that's all in the annual reports
Sure.
For each of the regions. So I might leave it there just in interest of time.
Yeah, that's great, Fiona. Look,
but it is a very quick snapshot.
Yeah, that's fantastic overview. Thanks, Fiona. I've got a question here from Peter Haverland. The South Australian cow production looks exceptional, and based on the feed indicators, is this off grass? Like, what's driving this in South Australia? It's a question from him.
Yeah, so this is probably one of those ones, Peter, where when we're utilising an average as opposed to a median, it can have an impact on the results. So there are particular regions in the DFNP datasets, and in fact, almost all of the states now have TMR and PMR-based systems. I would say that there are, in South Australia, there's a straight TMR system and then probably 2 or 3 PMR-based farms, and they are swaying the average in terms of the production per cow in comparison to the other indicators. So need to keep in mind that the average on each of these is the average on each individual line. So it's not, taking the farms and doing an average of the whole component of the farm. It's of each individual measure. And when you do that and you have TMR and PMR farms, it impacts these results. So it's the same thing that you need to keep in mind when you're using dairy-based to look at regional data. TMR farms influence things like stocking rate, homegrown feed, and proportion of feed in the diet. So sometimes if you've got TMR, PMR farms in a region, it can be well worthwhile looking at the median when you're factoring in those physical components, because it probably gives you a representation without those farms in it. So for a graze system, possibly look at the median. I hope that answers that question better.
Yeah, great. Thanks, Fiona. Are there any other questions that people would like to ask? I've got a couple more minutes. I've just got one that's come through also, Fiona. It's about the positive cash position that farmers are probably got a bit more cash around at the moment. What are they doing with it? In your experience, are they reinvesting it, repairs and maintenance? Are they paying off debt? Like, what seems to be, what are they prioritising?
I'd say a mix, and across the board, across every region this year, I would say probably for the last 2 years, repairs and maintenance has been consistently higher over the last 2 years. Lots of catch-up occurring, so lots of people that held off in repairs and maintenance for those years that were tighter are definitely catching up on that. I'd say there's also been an element of an increase. I suspect that won't carry through necessarily to this year, but on a lot of capital fertiliser. So a lot more capital fert going on that hadn't traditionally been put on in tight years as well. This year, we definitely saw the highest level of capital purchases out of cash flow in businesses. Lots of people making the most of the 100% write-off on depreciation. So lots of new tractors, side-by-sides, motorbikes. People having cash and thinking, what can I do? So automatic write-off was certainly part of it. Definitely more farm management deposits coming into play, I would say, just to offset some of that. And then I would also say that there's a group of farms that are looking at off-farm investment. So they're actually starting to look at transition options for their businesses looking into the future. So whether it's succession planning to bring kids back on farm or whether it's an exit strategy, there are definitely some of them looking at off-farm investment as well.
Yeah, Oh, that's
Yep.
a really good overview. Yeah, it's a whole range of things, isn't it, really? Well, that's been
Yep.
fantastic. Thanks very much, Fiona, for that national overview. It's really interesting to see the differences between the states and what some of the factors driving those differences. So it's now 9:30. What I might do is just quickly share this end slide with everyone, just in case they want to have more information to follow up. And I'll just... So look, thanks everyone. That brings us to the close of the Dairy Breakfast for today. And thanks very much to Sheena and Fiona. I mean, it's been a huge effort to pull together those results. We know how much work goes into that. And it's just fantastic data to have for the industry and to see how we're kind of tracking from year to year. Look, both of them mentioned different tools that you can go to after this event. If you want to see, I mean, you can do Dairy Base. I'm sure a lot of you are aware of Dairy Base, but the Farm Snapshot tool, which Sheena shared. And if there's any farmers that are interested with getting on board with Dairy Farm Monitor for 2022, please get in touch. But hopefully on New Year's Day, everyone's going to tune into our Dairy Business podcast as a bit of R&R on New Year's Day. But look, thanks everyone for joining today. It's fantastic to have everyone here and wish you all the best for the Christmas New Year break, and hopefully you can have some rest and relaxation. But thanks everyone, and see you in the new year. Probably in March we'll have the next breakfast, but thanks again.